Very much. Now, if I get the technology to work, I'll be all right. Well, thank you for the invitation to talk about some of the policy considerations under what I'm calling farmer-friendly investment, because I think investment debt and what impact that has on not only existing farmers but future farmers is becoming more and more an item of discussion. I think it was outlined earlier, rising farmland values are something that we're seeing, particularly in the last few years. And I think this is driven by a number of things. Low interest rates, I think, have encouraged people to look at making investments in farms. The high prices that we've seen, particularly in grains and oilseeds over the last couple of years, I think have driven some of the investment as well. I'll mention a little later that there's some sort of a caution we have to put into that. And I think the development of international markets, so that there's some international markets that we can see ongoing sales coming. One of the things, though, that I think is key when you look at the overall numbers, it's farmers that are driving the prices. It's not necessarily outside investors. There are some local situations, though, where people are buying property for recreational purposes. There are places where urban development has driven up land prices, and those farmers have sold out land and paid possibly more for other areas. And there are some areas of the country where foreign investment is becoming an issue. I had it mentioned to me this morning that one area in Manitoba, 78 quarters, I believe it was bought up by outside interest. But by and large, across Canada, it is still farmers that are investing in this land. So what does this mean for farmers? Well, the first one is very simple: increased capital investment. And then the other is the whole aspect of non-farm investment attention. It's something that's really just starting. Farm debt, this graph is actually taken from the United States, but one of the things it shows is the ratio of the amount of debt that's tied up in real estate and the amount that's tied up in non-real estate debt. And it shows that real estate is starting to absorb more of the overall debt percentage than other non-real estate assets. I think one of the things, though, that we need to look at when we're looking at these ratios is the overall amount of debt that's there. Overall, Canada's debt has increased about 150% in the past 2 decades, approaching $70 billion. It's interesting to note, if you look at the U.S. number, they maxed out about 350 to 400 billion in total debt. But if you take that as a ratio, with Canada's debt at 70 billion, we should be closer to 700 billion in the States. I was going to ask the previous speaker if the lower levels of debt in the United States might have some relationship to the U.S. Farm Bill and the fact that some of the direct payments have helped them absorb some of the volatility in the marketplace. I think it would open something up for a lot of discussion. On land prices, though, I think it's fair to say that returns don't always justify the land prices. If I look, I farm in northern Ontario, where land values are very different than what they are in the south. And when I see the numbers approaching $20,000 an acre, I think you have to recognize there's a number of other factors involved in there, depending on the individual situation. If you have a large operation and you're adding to that situation, you're spreading that debt over a large operation. But I think one of the things that's coming out of the discussion is that there's a lot more long-term planning needed when making some of these decisions, and I think that's where it enters into the sort of policy discussion. Conference Board of Canada actually put out a report this year on the importance of farm management, and I think more and more you can't operate a farm by the seat of your pants, starting out like I did in the 1970s and very little background in business. You need to actually do some of the evaluation on purchases being made and try and make those purchases more based on actual facts and emotion. And I think in every case it's going to be different depending on your crop you're growing, the efficiencies you have. One of the things I would like to mention, though, is Farm Management Canada is starting a program, Risky Business now, that looks at evaluating risk, and this is a lot broader than just looking at the risk management tools you're looking at. It's looking at your overall farm debt, your sensitivity to a raise in interest rate. Actually, I come from a year in the early 1980s where I saw what happened when you had dramatic increases in your interest rates. It wouldn't take that big a spike now to really stress some farm operations. So I think one of the policy considerations that has to be looked at is this whole aspect of farm business management planning and long-term planning and looking far out into the future. The other aspect with high land values is the impact that has on farm transfers. I think every situation is somewhat unique depending on the type of farm you have, the makeup of the family, how many members of the family are involved in the farm operation. But we do know that there's a large number of farms will be transferring in the next number of years, and I think it illustrates the fact that we do need proper planning in order to make sure that those issues are addressed. The whole issue of succession planning, how do you deal with the children who are not on the farm? How do you ensure that the value that you're passing on isn't so over-leveraged that the new generation can't take it over? Looking at things like leasing options. I think there's a whole series of issues that have to be addressed here, but I think it boils down to that need for tools to address some of those issues and to try and make sure that the plan in place looks at the different things that can be used moving forward. We've been exploring the whole issue of farm transfers and what can be improved, and I think one of the things that we need to start looking at is a tax policy environment that encourages the transfer from one generation to the other. When you look at farmland as an investment, high returns and low volatility, that has sparked the interest of investment firms looking at putting money into agriculture. I know there's been a lot of talk about it. When you look at the total acres, there's 500,000 acres approximately are tied up with financial investments currently in Canada out of a total of 160 million. So it's not a significant amount, going back to the point that this isn't one of the aspects driving farmland costs, but if there is more movement on farmland as an investment, I think there are a number of policy issues that have to be looked at, one of them being the whole aspect of land tenure. It's interesting, I come from the province of Ontario, and if you rent a house to someone, they have a lot of legal protection under the law as to what the obligations are of the leasee and the tenant, whereas if you get into farmland rents, quite often, if the landlord decides to get an extra $1 an acre from somebody else, you can be out after making investments in that land. So I think there's a whole series of policy issues on farmland tenure that have to be looked at as we look at some of these off-farm investments. And I don't know if it can be said that this investment is good or bad. It may be a tool that can be used by new entrants that are coming into farming, where if they can get a long-term lease on land, they may be able to develop a business plan that's more realistic than tying up all of the capital that's necessary as you move forward. Also in farmland investment, we're seeing a number of different ventures coming in. Bonfield's one of them, OnEarth Farms, there's Assiniboia Capital Group. There's several of them that are expressing interest on that, and I think it's a trend we will likely see going back to the previous slide, because of the fact that if you look at the long-term trend on farmland, the value is there. If they can rent that land and recover some of their costs, it really makes a stable piece in an overall investment portfolio. So if you go through the opportunities and risks, I think opportunities for the investors are very apparent. It looks at farming as an opportunity. I think long-term going forward, if I look at what's happened to my mutual funds compared to what's happened to my farmland, it's not a hard sell to see farmland as a good investment. It does put an infusion of capital into agriculture. The presenter early this morning mentioned about the high capital cost of getting into farmland, and some of this extra investment coming in, if it's managed properly, could be good. And then it does give those increased rental and leasing opportunities. The risks, though, again, on the other side are loss of control of a productive asset. But I think what we have to start looking at is what kind of tools do we have to guarantee that that land tenure takes place. I sometimes look at my son-in-law, who owns a business that's not related to farming, but he doesn't hardly own any of his assets. They're all leased. And it's not a philosophy that we've had in the agricultural industry. So I think we have to really concentrate on the whole aspect of tenure. And then some of the potential risks are making sure that the sources of financing are there. When it comes to farmland investment policy, I think there's a whole series of policies that have to be looked at. There's federal and provincial jurisdiction. The ownership restrictions vary. I mentioned foreign ownership. If you go to Western Canada, 3 Western provinces have varying types of farmland ownership policies in place, but they're somewhat different from each other, and then in Eastern Canada there's little. One of the aspects, though, that we do find is getting proper data on what is happening on farmland ownership so we can make some decisions around that. And even at the provincial level, I know in the province of Ontario, I'll give you an example, is there's a preferred municipal tax rate if land is used for agriculture. So on our farm, we rent about half of our land. For those people that are Canadian residents, I can sign a sheet of paper because it's being used for agriculture, and they get the preferred municipal tax rate. However, if it's an American owner or a foreign owner, the same doesn't apply. So there's policies like that that can affect the use of that land. So I think there's a number of things that have to be looked at on that. So what role does government policy play? I think we'll likely find some of that coming out of the discussion on this session and the other sessions that are being held this week. And CFA is actually working with Peter Bell at the University of Victoria about farmland ownership restrictions, trying to get a handle on how effective they are and whether they're actually doing the things that they were set out to do. So to conclude the presentation, I would say there's not a lot of answers right now, but there's a lot of questions. I think we can identify some of the trends that are taking place. I think we can see that investment in farmland right now is seen as sort of a positive sector of the economy, I think, which is overall good for agriculture. I think what we have to address is those issues of land tenure, the issues of farm management planning, and the issues of what types of government policy can encourage that farmland to stay in agriculture. Thank you.